Thank you, Senator. Senator Warner.
Thank you, Mr. Chairman. I want to follow up on Senator Haggerty and Senator Alsabrook's. I think I agree. This is something we need to do, and I appreciate, Senator Haggerty, your good work here. I love to have the discussion about if we do add more contingency. Mr. Potsley, am I screwing up your name? Or so we just call you Potsyadsley. I do think the debt right now is overfunded, but I think we got to get into the nitty gritty on this. But I agree with looking forward to working with Senator Haggerty and also Brooks on this. I want to, one of the things I've been frustrated with, we're years after Silicon Valley Bank, and I always felt before we start rechanging the regulatory structure, we ought to make sure that we're using the tools we've got. And one is the discount window. And so I've been working for a long time on trying to remove the stigma, and I find it not a great reason that you've got, when the Fed was initially set up, the discount window was that liquidity tool, and just the idea that, well, it's going to be a stigma is somehow that means we shouldn't be use it. I've got legislation that would have this better utilization, demonstrate that banks can use it on a ready basis. Silicon Valley didn't even have anything set up to do that. So we only use the deposit insurance as a last resort. One of the things my bill calls for is to look at pre-pledged collateral. And would you agree that that tool is something that should be counted as banks look forward? And how do you generally think about better utilization of the discount window?
Well, thank you, Senator, for the question. And I would say this, that, liquidity is the ultimate arbiter of a bank run, right? Like, liquidity kills. Right. Like, you can have as much capital as you want, but if you're not liquid, you're going to have a run and you're going to have an issue. So anything that establishes or creates a more liquid opportunity for banks to get funding is helpful. And I would support that.
And one of the things there was a lot of buzz after Silicon Valley about how we grapple with the ability to have accelerated runs driven by technology. And candidly, I think some of the folks who spooked the market bore some responsibility. None of that went anywhere in terms of, no matter what kind of capital you have, if you've got 1 out of every 4 deposit dollars leaving the bank in 6 hours, as was the case with Silicon Valley, I'm not sure how we get at that. I want to go to, and I would welcome ideas. Mr. Harrison, Mr. Rice, one of the tools that I've also a big advocate for is reciprocal deposits. We've seen a big upsurge in that. How do the reciprocal deposits ability fit into this discussion about the insurance component? And I've got a quick question for Mr. Kelly afterwards. So I want to hear Mr. Harrison and Mr. Rice on this.
Yes, Senator, thank you for the question. The reciprocal deposits have a role, but candidly, it is a workaround. And it's a workaround that is private-based, based on somewhat dated technology. And candidly, it went up quite a bit after Silicon Valley, and there are some systemic risks that could be seen in that. Going back to your discount window question, the regulators and the banks have been working very closely on that to smooth the operation of that. So it's an operational issue as well as the stigma. And I think that stigma is going to go away over time.
Mr. Rice.
Reciprocals are great, sir. Reciprocals were $67 billion before the crisis and rose to $173 billion in banks. So there's a capacity issue. So it's a nice little tool. But I also want to point out that First Republic survived the first wave of bank runs. Banks put in another $30 billion. But it was the reports that said they lost more deposits than initially reported caused the second run, which the bank could not have failed. So your point, sir, is right. You do need to stop fear in its tracks when it enters into our system.
And again, the excuse that we don't want to use the tool because of stigma, we just have to grapple with that. Mr. Kelly, I've been a huge advocate for CDFIs, as we've visited in the past. One of the things that we've started, and again, with great help from Senator Crapo, Economic Opportunity Coalition, where we're trying to get long-term deposits into CDFIs and MDIs. How do we how do we do more of that? Because we obviously, and President Trump ought to get credit for this, he's now kind of undermining CDFIs, but he was the godfather in terms of the last COVID bill. We got $12 billion in Tier 1 capital. How do we make sure we keep these economic opportunity coalition ideas alive?
Senator Warner, thank you for your leadership. You do recall that you were part of that leadership that helped ESIP happen during Trump 1.0, and it has certainly been impactful to the CDFI space, so thank you for your leadership in that regard. In most cases, many of our banks have used reciprocal deposits as an opportunity to create that level of security with those large depositors for our banks. And so it has been a critical component. I don't think it is the answer in totality, but it certainly is a complementary component of this. And so I'd just like to tell you thank you again for your leadership on this topic. I think this is what what we propose is what you're describing.
Can I just, I know our time's up, but I just would urge my colleagues, many of you are part of the CDFI coalition. Secretary Bessent has been very supportive of as well. We've got about $600 million that hasn't been released. The Secretary wants it, but we really could use some help getting those dollars released before the end of the fiscal year.